Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday the 31st of August 2020, and yesterday we published a video entitled, Is China Pointing the Way to a Global Banking Crisis? And of course on Saturday we produce our Gold and Silver Weekly Update for the weekend in the 28th of August. We've placed links to both of these in the description box below. Now we pointed out in Saturday's video that we were likely to see higher gold and silver prices in the early part of this week because of Jerome Powell's statement last Thursday concerning interest rates, and this is exactly what we have seen. In fact, his comments were more to do with inflation, but then the impact of not raising rates, because he has indicated he would allow inflation to rise above the 2% target, would therefore mean that for some considerable time the US dollar could potentially be under pressure. Now the UK markets are closed for a bank holiday, but nevertheless trading continues around the rest of the world. Gold is currently up nearly $6 at $1,971, and silver is up a significant 76 cents at $28.29, with the dollar index languishing at 92.17, that's down 0.2. Now we're going to talk about inflation, especially, as mentioned, it is the fact that Jerome Powell stated last week that he is basically prepared to allow inflation to rise above the 2% target figure without raising interest rates. But first, let's take a brief look at what Reuters have to say about the markets in general today. Reuters article dated August 31st, 2020, 1:53 a.m. but updated 28 minutes ago, and the time currently is 20:07 GMT plus 1. New York. A gauge of global stocks pulled back from a record high on Monday, but was poised for a fifth straight month of gains, while the dollar remained lethargic as investors adjust to the policy shift outlined by Federal Reserve Chair Jerome Powell last week. US stocks were mixed, with the Dow Industrials in the red, the S&P 500 near unchanged, while the Nasdaq rose solidly. The S&P is up more than 7% for the month, putting it on track for its best August since 1984. August is traditionally a softer month for stock performance. The Nasdaq is on track to best the S&P's performance for the month, up nearly 10%. It's back to Nasdaq leadership and profit-taking in other parts of the market, said Liz Ann Saunders, Chief Investment Strategist at Charles Schwab. I worry that sentiment has gotten frothy and there's a lot of money in the market that doesn't see any downside risk. Fed Vice Chair Richard Clarida on Monday expanded on Powell's comments from last week, saying that with the US Central Bank's new policy view, a low rate of unemployment does not on its own trigger higher interest rates. Last week, the Fed said its new strategy plan is to use higher inflation when the economy is robust to offset the impact of periods of weaker prices. Monday marked the first trading day for the revamped Dow, with Salesforce.com, Amgen Inc., and Honeywell International Inc. joining the 30 component index, and Mobil Corp, Pfizer Inc., and Raytheon Technologies Corp. being removed. Each of the new components was lower on the session. The Dow Jones Industrial Average fell 207 points. The S&P gained 0.27 points, and the Nasdaq Composite added 117 points. The dollar edged lower against a basket of major currencies and was set for a fourth straight monthly decline. In Europe, stocks closed lower on the day as financial shares were weighed down by soft inflation data in Germany and Italy, but managed to close higher for the month. Trading in London was closed for a public holiday. The MSCI's World Equity Index, which has risen more than 6% in August, is set for a fifth month of gains as massive monetary and fiscal stimulus outweighs concern about the outlook for a world economy battered by the coronavirus. The index hit a record on Monday, before reversing course on the day. Okay, so let's go back to inflation. Markets, quite rightly, are excited as it looks as if we could have quite a few years ahead of very low interest rates, languishing at or around 0%, and in some countries' cases in negative territory. As we pointed out yesterday, this could be positive, unless of course you are a bank, which we expect to continue with quite extensive losses moving forward. But we must also not get too excited about inflation either. We hear so many commentators stating that all of this stimulus is going to lead to a major rise in inflation, and then hyperinflation much sooner than anyone expects. Well, do not naturally assume that, because an article published by Bloomberg today is suggesting that certainly as far as Europe is concerned, the opposite is happening. So let's take a look, and we will comment after looking at that article. Bloomberg article, dated August 31st, 2020 at 1:05 p.m. GMT+1. Headline: European prices are sliding as economy fights for virus recovery. Consumer prices are sliding in Europe in the wake of the coronavirus lockdowns, with Germany, Italy and Spain all reporting negative inflation rates in August. German consumer prices fell an annual 0.1% in August, the first sub-zero reading in more than 4 years, with downward pressure exacerbated by a government sales tax cut to aid the economy. The declines were even sharper in Italy and Spain, two countries hit especially hard by infections and travel restrictions. The figures demonstrate how the pandemic is further depressing inflation in the Eurozone that was considered too low by the European Central Bank even before the crisis. The extent to which prices slide will help determine whether the ECB ultimately needs to add more monetary stimulus. President Christine Lagarde already warned last month that inflation rates will decline further before picking up early next year, but that depends on how the economy progresses. After an initial sharp rebound in activity that hinted at a V-shaped recovery, momentum has slowed recently. Infections are on the rise again after the summer holiday season, stoking fears of new lockdowns and yet higher unemployment. ECB chief economist Philip Lane has warned against drawing conclusions too soon and pledged that the central bank stands ready to step up its bond-buying program or adjust other tools as needed. The latest inflation and unemployment figures for the whole 19-nation currency bloc will be published by Eurostat on Tuesday. We recall when central banks reduced rates as the result of the 2008-9 recession that inflation would be a significant concern. And in fact, it was the prospect of deflation and stagflation which central banks ended up more worried about. The same could potentially be the position moving forward, at least over the course of the next couple of years. Look at Japan and see how they have failed to make any significant level of inflation a reality. In fact, looking back in recent history, we did not really see a significant level of inflation until the mid-1970s. Now, we're not suggesting that this will happen in the US and the Western world at large, but for those relying on inflation to provide the gold and silver surge in prices, you may have a little time to wait yet. The good news, however, for those holding precious metals like you and I, is that until inflation and growth re-enters the economy, more stimulus is likely to be applied, which, by natural consequence, will undermine currency levels, and particularly at this stage the US dollar, thereby increasing the value of precious metals. Now, black swan events apart, we would expect to see the real surge in precious metal prices to occur when inflation begins to take hold, which is why we have frequently advocated that the most significant rises will not necessarily occur in 2020, but closer towards the 2022 to 2025 timeframe. Will we be right? Well, only time will tell. But meanwhile, until that happens, for those who are light in precious metals, naturally it is a good time to accumulate. And also to share your thoughts on where you see not only precious metal prices moving towards, but whether we are going to encounter inflation in the short to medium term. Thank you so much for listening, and if you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.